Okay, well, first of all, it's a pleasure to have all of you on the stage. Sorry we can't let you, introduce yourselves properly, but perhaps with your first answers, you can say a little bit about yourselves as well. I'll start off, first of all, with Petra. So, I think we've heard enough of this already. Everyone's talking about the challenges that we're facing in the world today, from climate change and, of course, the problems, but also the beauty, you could say, of technology. Regulation has come up a lot as well. So we're also living longer, we're having less money available, at least for some people, as costs are rising for people and businesses. So talk to us about the role that regulators like EIOPA need to play now in this climate, all puns intended, to help insurers evolve and adapt to a changing society.
Great question, and hi everyone. I'll just dive quickly into the question. I think that's the most. So, what is the role of supervision? I had a discussion with my staff. What is our role today in the new environment? I think it's an important role. I think good regulation, smart regulation, but also supervision is essential for a market that builds trust. In the end, it is about trust. Being robust is necessary. And if you look, for example, at the first week of March, where somehow simultaneously the German government and the EU presidency went out stating huge numbers that they would start investing in defense. And what that did to the markets and how the markets moved, we went into 50% of the insurance stress test just spontaneously in 2 days. And no one noticed. It did not make headlines. It didn't do anything. Why? We're robust. And I think that in the end, that is the core of what supervision is, being robust. So what we need to do is continue to flag that. And I think appreciation for regulation, the need to also be conscious that it shouldn't hinder long-term investment. We agree with that. We advised on that. I think that is wise. Also in Solvency II, some reduction there is appropriate. But going beyond that is no longer simplification. It is also not economic. It's just simply deregulation. And I think supervisors need to continue to flag that to anyone who wants to deregulate. It is tempting, but there is something you can do that is simple and better, and then there is plain non-economic deregulation, and that we should be careful for. I think that is a role for supervisors. The second thing we need to do is continue to work together with our international colleagues, and we do that. We saw each other last week in the US with an excellent conference as well. I think continue the dialogue. Insurance is about purpose. It's not about politics. That was said also at the conference in the US. And I fully agree with that. So continue the cooperation. We are supervisors. We need to work with our industries to help actually deal with risk in a time that it's more uncertain in the world. And there is a need for insurance. And finally, as European supervisors, we need to work together. We need to build that supervisory community that works in unity, that feels responsible for problems in the market as a whole and not just in their member state. Because for me, in the end, a successful SIU is an ability of member states to start thinking European instead of member states. And I think here we need to continue to also put that on the table. I'll stop there.
Thank you so much. I'll move over since you mentioned him as well. Petra was talking about collaboration and everyone working together. How possible is that, given the sort of environment, or the political environment, I should say, in the US? So we're living through, of course, Trumpian times. He's a president who promised a lot of, I think, regulatory policy. He keeps trying to bypass legislature but then also getting shot down by the judiciary. He's doing a lot. We're noticing it, beyond the insurance sector. Your president does a lot. Is it having any impact on your sector and your ability to work with the rest of the world?
Well, first, I just want to say thank you for the invitation to be here. Really appreciate being able to represent the U.S. and the NAIC and be a part of the conversation today. And I'd like to start by responding to the question by kind of reminding everyone that in the U.S., insurance is regulated at the state level. So while we obviously engage with and are impacted to some degree by federal politics and decisions that are coming out of Washington, D.C., really our regulatory approach and the decisions we make in terms of the main regulators of insurance in the U.S. are insulated to a large part by or from the federal government. I would say it's really a testament to one of the strengths of the state-based system is that regardless of what's happening in Washington, D.C., and regardless of who the president is and the kind of federal political times we find ourselves in, the state-based system in the U.S. provides stability and provides a certain amount of kind of consistency in terms of how we can continue to do our regulatory work. So in terms of our ability to continuing to engage, I won't speak to decisions that the Trump administration is making, but from
no, please do. Why not?
But from an NAIC standpoint and a U.S. insurance regulatory standpoint, relationships are very important, as Petra mentioned. It's important that we continue to engage with our European partners, with frankly all of our partners across jurisdictions around the entire globe. We are active participants in the IAIS. We continue to be involved in a lot of work through that organization. A number of other organizations as well, OECD. We have the EU-US Insurance Dialogue Project. Because from an insurance standpoint, we feel that it is really important that we maintain relationships and that we also understand kind of the jurisdictional differences in terms of how we approach the regulation of insurance. We continue to see growth of insurance companies and insurance groups becoming multi-jurisdictional, global, and in order to effectively regulate companies of that size, we need to have these relationships, and more importantly, we need to have an understanding of how each other's jurisdictions operate. And so we remain firmly committed to being partners in these discussions, being involved with these international organizations, and we think it's really not just helpful, but really critical for the work that we do.
Okay. Tilman, I'll come to you next. There's been talk already about regulation. Perhaps is it fit? I don't think anyone used the words fit for purpose, but I'll just call it that. Is it fit for purpose? Is it doing exactly what it needs to do? I know the Commission always gets criticized for everything under the sun when it comes to regulation. So unfortunately, sorry to bring up regulation here, but there's also a key, when we're talking about relationship, there's obviously a relationship that the Commission needs to have with all the industries, especially the insurance industry since we're here at AltaWorld today, but also the biggest relationship you need to have is with the people, Europeans. So can you talk us through the mechanisms that can help promote this wealth generation for everyday people, and what does the Commission see as the key role for the insurance industry?
Well, yes, thanks a lot. My message on regulation is pretty simple and straightforward. We have the solvency system, and the solvency system is supposed to be market-driven, and as we've heard this morning from Thierry, it's supposed to be economics-based, and the way we want insurance companies to invest should be driven by their liabilities, and we have created a system which in a theoretical model looks perfect. It is sort of valuation is done on the basis of market, of swaps. We look at bond volumes. And the thing is, we have a perfect system, and we say it's market-based and market-driven. But I guess what SIU is all about is now we actually need the market. Because that is a tendency in insurance. So I'm not an insurance person. I come from the market side of FISMA, where we regulate financial services. And it's interesting that we say that insurance should be market-driven, but we are not always looking at the market, or in the European Union, we sometimes maybe also need to develop those markets, that they produce all that market data that the insurance companies need to do their valuations and their investment decisions. And that is what the SIU is all about. We are looking to create markets, to create liquidity in our markets, be it in swaps, be it in debt instruments, because that is sort of the data. These instruments, when they're traded, they produce the data that we need to do all these valuations on the solvency system. And that is often a bit forgotten because the insurance people, with all due respect, they're like actuarians. They like statistics. They like normal distribution. And then when you confront them, well, the market doesn't work with normal distribution. There are certain liquidity pockets in the market, and you need to respect that. They're kind of a bit surprised and say, oh my God, what is happening now? Why is the 25-year swap not as liquid as the 5-year swap? Well, okay, that's just the market. You need to look at the market. So I think we as FISMA, we take the holistic view. We want to have stronger capital markets in the European Union. That's the SIU project. We want to have more consolidation of the market data. We've had lots of projects where we consolidate market data because those are the inputs that the insurance companies need to actually have a market-driven solvency system. And as long as we don't have the market, it's a bit sort of theoretical to talk about a market-driven solvency system. And that is the big challenge, and that's the next 5 years, and that's the agenda.
Okay, that's the next 5 years, and that's the agenda. I can see your face. You seem to be having a bit of a reaction to that. But Mikhail, I'll ask you first then. What do you think about Solvency II and all the sort of regulation that the Commission has put into place?
First of all, I would agree with what Thierry said before. I think that Solvency II overall is a big success story and a huge step forward also for the European insurance and reinsurance industry. Are there things that can be improved? Of course, and I think Thierry mentioned that. For example, as a reinsurer, of course, for us, reflecting the business model of reinsurance is essential, and that's why the internal model for us is fundamental. And there we do not want any, let's say, regulatory distortions in a way like benchmarking the internal model against the standard formula, things like that. But that's one part. Overall, and that's not only Solvency II, but regulation overall, I totally agree with all what was said about the needs in Europe, about the intentions, about the objectives. But at the very end, when we say we need more investments of the insurance industry in European infrastructure, for example, at a very practical level of the investment decision, it comes down to the risk-return profile of the investment object. And there we are global investors, and that's why it's the relative risk-return profile. And anything that improves this risk-return profile will help to achieve all the objectives that we have been mentioning. And regarding Solvency II, there are, of course, also a few things. For example, too high capital buffers, the infamous risk margin, which in my view as an economist is rather a duplication of other formal capital requirements. And if we say relative comparison, if we look at other prudential regimes like Japan or UK, the risk margin is lower. If we look at the US, it's not there. So this is one point. I could also imagine that, for example, a more, let's say, pragmatic and more easy to use way of classification of investments could be helpful in Solvency II, where, of course, there are reduced capital requirements for certain qualified infrastructure assets, but if you fulfill certain criteria, but fulfilling those criteria and especially also establishing the necessary documentation often is just very burdensome, and at the very end it's a question of cost and benefit, and there might be some things that can be improved. So overall, I think it's really a big step forward, but there are some aspects where I think that especially operational burdens could be reduced.
Okay. Nathan, quick right of reply. I saw you sort of nodding your head when Mikhail said the US is not quite there.
I mean, I think we just have a different approach. You know, obviously we have our principles-based, risk-based capital approach, and it's just a different approach to how we deal with capital oversight and regulate the kind of financial side of how insurers operate.
Okay, and then Petra.
What I want to say for the Commission is that We are aware of the differences in approach, and we will defend our model, but we will also make sure that our model doesn't make us less competitive. I think that is a clear message, and I think if we look at how our model interacts with the market, we can simplify a lot of theoretical assumptions by just looking at the actual market data and feeding that into the system.
Petra?
Where am I responding to?
All of it, really.
I mean, in general, about regulation, where are we? And maybe briefly on the internal models. Internal models are an integral part for the supervisor as well of Solvency II. I think reinsurers are a perfect example. If you have the standard formula, which is a model, then and one size doesn't fit all. If one size clearly doesn't fit all, you need to fix that. Now, there can be an add-on temporarily, but ultimately you will then have to move to an internal model. And reinsurers are not insurers, so you need the internal model to actually be able to really do the risk management in a proper way. And so in that way, I think it's just part of Solvency II. It gets more sophisticated, and it's actually quite an investment for both the industry and the supervisor to have it. But it's just a better reflection of how we address risks. Maybe another comment, important, the 10 trillion was mentioned in assets. 75% of that is already invested in EU. I think that is always relevant to say. So already insurers do a lot in EU. There is a discussion, is it risky enough? Now changes to the capital requirement for equity risk will probably do something there. I hope that. Another comment I need to make is that with all the changes that are proposed with regulation, and I already said what I think about that, but let's assume that or part of that happens, then as an industry, you can also count on the fact that 2-3 years from now, there will be a knock on your door and saying, where did the capital go? Did it actually go into supporting the transition in EU? Did it support startups? Did it support scale-ups? What did it do? And then there has to be an answer, because there has been changes to capital requirements before based on the promise that they would result in massive additional investments, and it didn't happen. So I think also be up for that as an industry, because ultimately, if you simplify, and by the way, EIOPA, a year before President von der Leyen said 25%, I told my team, when we are going to review Solvency II, I want 20% less. And at that time, we already were reviewing the ITS on reporting, and we reduced their 16% of data points for small and middle enterprises. So what we're doing now is indeed we will produce guidelines that have less articles. We move it up to 25% where we can. Does that one-on-one translate to reduction burden for industry? No, it's text. But it sets a mindset in my team that I want there to be, that do we really need it instead of would I like to keep it. We will also come out with an ambitious proposal on the reporting changes for Solvency II. But when that is done, and I think things need to get done. I think we need to get done on all the legal changes. All the legal changes. We set 5 years, but also for EIOPA, 10 more mandates without any resources. That is a lot. And we need to we need to be more principle-based. We need to take time. We need to do impact assessment. We need to see use cases. Then we need time to implement. That was the idea. Where are we now? I have an omnibus directive that puts all the green legislation up in the air. I have Solvency II that is up in the air. I have a retail investment strategy that's up in the air. VIDA is still discussing, and now we're also going to do PEP and IORP. So everything that is my regulatory framework is currently up in the air. Okay, so let's work through that period. Let's do it smart and simple, but then let's stabilize. Let's move into a phase of stable legislation, because I think that is what we need as an industry and as a supervisory community.
Okay, Nathan first, and then we'll go to Tilman.
Yes, and a couple things Petra mentioned. I just want to kind of touch on how, I mentioned we have a different approach, and I think just kind of building on what Petra said, it highlights the different approach that we have in the U.S. If you go back to 2007 to 2009, coming out of the great financial crisis, there were a couple On the policy front, we had in the US the Dodd-Frank Banking Act. New regulations on banking were implemented. And then we also had the prolonged low interest rate environment, which obviously wasn't unique to the US. But those two things led to a lot of changes that we've seen take place since then in terms of changes in the investment landscape, where we saw traditional banks pull away from making investments in the real economy, and institutional investors, including insurers, life insurers in particular, kind of stepping into that space. And then with the search for yield and kind of the challenging environment with that prolonged low interest rate environment, we saw insurers becoming, and again, primarily life insurers, becoming more aggressive, innovative with the types of investments they're making. So moving away from the traditional bonds, common stock, traditional investments that life insurers in particular had held on their balance sheets, to more, what we kind of generally call alternative investments now, asset-backed securities, just more structured products overall, less liquid, more complex. And of course, as part of that, we also saw more private equity companies moving into the insurance space over the last 10 years or so, partly because they obviously saw opportunity with these changes, but also insurers realized there was a partnership opportunity because finding yield and identifying these new complex investments and doing it the right way required the expertise that the private equity firms could provide. So, over the last 15 years or so, those have been really some of the defining trends in terms of the insurance investment landscape in the US. And now from a regulatory standpoint, we've spent, and we're still in the process of basically reviewing and making changes to our investment regulatory framework to make sure that we are adequately understanding, assessing, and kind of capturing the risk associated with these new investments in terms of proper RBC charges, in terms of proper accounting, reporting, disclosures, asset adequacy testing, just a number of different regulatory tools that we use in terms of how we regulate insurer investments. So I say that as it's more of a, we've taken more of a responsive approach to kind of the market-driven dynamics and investment changes that we've seen over the last 15 years or so.
Okay. Tilman, would you like to have a right of reply?
Yeah, I think we at the Commission, just because Nathan mentioned the diversification into new asset classes, into alternative assets, the involvement of private equity taking over the asset management part of an insurance company. We at the Commission welcome that there is more diversification in insurance portfolios, and that they explore new asset classes, and that they develop the expertise to understand the risk and return profile of these asset classes, and that they do this on an international scale. This is absolutely welcomed, and I think that also requires that the system is, as Petra puts it, sometimes up in the air, because the system is not stable, and the system was designed for certain asset classes, and now the other asset classes comes along, and we cannot just say, okay, you do exactly the same thing now that you have a more equity tilted portfolio as you did when you had all bonds. I think it's natural that we have unprecedented challenges, as everybody pointed out this morning: climate change, longevity, pensions, that everything is up in the air, and I'm getting used to that. Every single Commission mandate, everything is up in the air, and there is never any stability because the environment is up in the air. So we can't just pretend that nothing's happening, and insurance is the one piece of regulation which is future-proof and therefore will never have to be changed. And that is why, by the time, for instance, we implement regulation in these famous delegated acts, or the secondary layer of regulation, we look at political compromises which are already kind of, again, belonging to another era. And now we are implementing it in a new era, and that's why our boss, the new commissioner for financial services, Mrs. Albuquerque, put out this communication saying that we will implement also the solvency in light of what is now the political imperative and the priority. So we are favorable to diversification, new asset classes, but we acknowledge that sometimes the system then has to adapt as well.
Indeed, and when we come to future-proofing and adaptation, I mean, it was said earlier about when it comes to technology, and Mikhail, probably you can come in on this one. You know, how can insurance really leverage all of these new technologies, especially things like blockchain, to really expand investments? And again, I guess, where does regulation come into all of this?
Well, first of all, I think that insurers are very keen to leverage those technologies and also need to do it. We have heard about competitiveness of European economies. Of course, that's also something that we insurers have on our agenda, to increase our competitiveness, to increase productivity, and this is not possible without innovation and without using those technologies. And
But
I think
is there a real understanding of what these technologies are, especially when it comes to things like blockchain? Because it's highly complicated.
it is highly complicated, but I think it can work, and we are starting to implement it. Just one example, MEAG, our asset manager at Munich Re, has acquired a short-term bond secured by trade receivables from medium-sized companies. And this transaction was processed via private blockchain. And this did work. It worked well, it's efficient, and we can do that. Of course, regulation also plays a huge role there. We have heard it in the morning that for those innovative areas, regulation needs to allow also for experimental phases and needs to be pragmatic, and I think that's totally true. There's one example in Germany, when there's the so-called Electronic Securities Act in Germany, which is now very important. Bearer bonds can now be issued as crypto securities, and they have to be then registered on the crypto securities register. And what we have seen from some test cases and from some balloon cases, that works well. However, there's a very limited liquidity on a secondary market for those securities. One of the key reasons being a regulatory one, because we know that listed securities need to be deposited with a central securities depository, and that's by nature not possible for crypto securities if they needed to be traded on exchanges. So once again, there needs to be the regulation needs to allow also for some experiments and some innovation phase. And if we want to scale up those technologies, then investors, for example, just need to be able to acquire, to manage, and to trade, just as one example, those crypto securities. I think that is possible, and I think that regulation is able to also adapt to that. But I also think that's desperately needed in order to increase productivity and innovation.
Just a quick side question. How does your sector insure people who are working in crypto, who are trading in crypto, who suddenly lose all of their investments, either because somebody perhaps stole their digital password?
Well,
I know that's happened to someone. I know someone that lost about 10 million.
Well, I think that the general insurance approach is not different to any other insurance approaches. We insurers need the data. We make our risk modeling, and then we set a price for that, and then decide to what extent it is insurable.
Yeah, so everyone needs insurance, even if you are a tech bro. Okay, so we've got a few questions from our audience. The first question is for Petra and Tilman, and they say, what are your insights about promoting auto-enrollment schemes, mainly occupational, for investment or pension products to boost European citizen participation in the market? Would you like to go first?
I think the question whether or not that's going to happen is lays with the Commission. So I think that's for Tilman. But I do want to say that for me and for EIOPA and the community, I think SIU is very much also about an opportunity for Europeans to close the pension gap that we have. and the gap is different in every member state. We all have a different starting point. I think it's essential to recognize that. But then beyond that, I think it would be really good if more retail investment, which is necessary for the European economy, but it's also necessary to help close the pension gaps. And working with the inertia of people, automatic enrollment could be a really good idea.
Yeah, I think auto-enrollment is one part of the puzzle, but the big challenge, of course, is to get more people involved in capital markets, because that makes capital markets more liquid, that produces more market data, and market data is the fuel which keeps that whole system going. This is why your example with these crypto investments, which are then held somewhere and are not tradable, that I don't like that much, because this is all kind of market data which we lose, and therefore transparency which we lose, and therefore valuation parameters which we lose. And I think if retail goes into the market, whether this is auto-enrollment, whether this is because we have products which are retail suitable and which we can sold online without lots of intermediation and investment advice, God forbid, because that what puts people off. I hope you don't mind when I say this, but investment advice is some of the major barrier for people to actually go into capital markets, because they don't have the patience to listen to these abstract explanations, but they are able to understand the system if their suitable products are offered to them. And so auto-enrollment is a bit, let's say, a shortcut, because you just are sucked into the market and you have to opt out. Voluntary participation and understanding, good online products, simple products, but yet capital market-based products, that's the kind of stuff we're promoting.
Okay, there's another question. There isn't a name given, so perhaps our other two speakers can take forward the question. Shouldn't the topic of Europe First put higher on the agenda? Perhaps should or shouldn't the topic of Europe First put higher on the agenda more bluntly? European savings and assets are not the most profitable, but we are Europeans, and this is our collective role to channel European savings toward European projects. So perhaps that's not a question for you. Europe first, okay. I mean, we're not talking about America first, unfortunately, but it seems everyone's adopting this rhetoric now, thanks to your president. So yeah, so Europe first. What's the approach?
Well, should I, maybe as an insurance, I would definitely not like that. I think that we see, as was also mentioned in what was said before, we see a global tendency towards a new economic world order. To some extent, that's not a positive development, because we see also increasing economic nationalism and protectionism. And very often that also comes, and that is bad news for the financial services and insurance industry, with a certain politicization of finance. And financial flows are not a political instrument.
Exactly.
And we as insurers in our economic function, first and foremost, have to fulfill our function as risk managers for the society. And we use the premiums to, of course, invest and to be able to pay our losses. But that must be market-based and must be based on risk-return profiles and not on things like Europe first or other economies first.
Yeah. Can I comment on that?
Yes, absolutely, yeah.
Yeah, so it's definitely not for a supervisor to say where you should invest. I think what is important is that people get a good pension, and I would leave that really to the market and the portfolio managers. But when it comes to Europe first, maybe we should say it to ourselves. What I see is that you can have maximum regulation, you can have a commission and institutions that take that European perspective. But as I said at the beginning, in the end, the success of a savings and investment union will be dependent on the ability of EU member states to not compete with each other, but together use the potential of a market with 450 million citizens to compete with the world. So I think maybe the sentence sounds the same, but I think when it's used by the administration, it means the entire US. Europe first, I mean, are we there? I see a lot of discussions in several files where in the end the national approaches lead to a lot of complications also in the trilogues and legislations that become very complicated. And I think the retail investment strategy is one where in the end the national is weighing heavier than the European. And I think this is a challenge. And it's the same with principle-based regulation. I'm very much in favor of that. But then if that happens, what is important is that don't then knock on my door that there are different interpretations across the single market on, for example, what is foreseeable dividends. Because you do it principle-based and then you allow for some space. But if you allow that in a single market, where people want a convergent approach, inevitably people start calling for rules. And I think this is the rethink we need to do. It's beyond reducing data in a reporting template. It's about how do we approach regulation, how can we move as EU with our single market to more principle-based, to allow the room, while at the same time thinking about the convergence. And I think you can do that if you have an EU first mindset within EU.
Exactly. I mean, I think just to say one thing, I mean, it seems as if this whole, America first, Europe first, it's very, if Europe was to start saying Europe first, it's very reactionary to what another country is doing. And the EU is built on its own set of foundations and principles, and EU unity doesn't, I mean, Europe first doesn't seem to really calibrate with, EU unity. But you want to say something?
Yeah, I just want to say again, state-based regulation in the U.S., as a regulator of one of those 56 jurisdictions, I don't direct, the insurers in my state where to invest. I'm not aware of any commissioner or regulator in any other state across the U.S. that's telling insurers where to invest. So, again, that might be happening at the federal level, and it's important to have that separation when we're talking about insurance regulation and how we approach our work as regulators of insurance.
Okay, I want to make a more nuanced view on the Europe first, because, I mean, you go through various cycles, and I think you talk about the foundational principles, and yes, the foundation was an open economy, and the foundation was based on trade between member states and trade with the rest of the world. That was how the whole thing was born, and that's why people like me joined. But over the time, this has changed a bit. So now I'll give you a more nuanced view on Europe first. I think it depends on who you are. So if you are a stock exchange or a provider of European infrastructure, you should be saying Europe first, because you want things to be listed in Europe, right? You want to have capital markets in Europe. You want to provide liquidity, trading for European retail investors also in Europe. The same thing if you're a clearinghouse. This is the famous Brexit debate, which is maybe close to your heart, because if you are a clearinghouse, you're going to say, hey, Europe first. I want these derivatives, these euro-denominated swaps. They're denominated in euro. They're my swaps, in inverted commas. I want them to be cleared and settled in the European Union because I want to have this market and this liquidity in-house, so to speak. So they're Europe first. If you are an infrastructure provider, the same for energy, I guess, these people kind of have a point in saying Europe first. I have to acknowledge that. But of course, if you're then a reinsurance company who lives off the back of international global diversification of many, many, as we heard this morning, uncorrelated risk, then of course for you, Europe first is poison. So you have to probably, with this Europe first, differentiate a bit who you are. And I think we are moving, as the European Commission, also a bit more down that road.
Okay. Is there any last comments from you, perhaps?
Well, maybe, would you need, we have heard about competitiveness. If you're more competitive than the others, you don't need a slogan Europe first.
Yep.
It's as easy as that for me. I do agree, maybe institutions, but under markets, if you're more competitive, investors would go to you.
But this is an extreme, I don't know, neoliberal or however I call that view. Because if you are a big market and you're competitive, and if you're a relatively small market, and sometimes Europe is in the latter category, you're not going to survive competition. You need to first build some sort of an infrastructure, some sort of scale, and then you confront competition. I'm amazed that I'm saying this because 5 years ago I would never have said this, but this is how times have changed.
Indeed.
But that is how you set up the infrastructure. From a company perspective, you decide based on the options that you have, and you choose the most competitive option. And if this is a European one, of course you go there, and you don't go anywhere else.
Yeah, but in some sort of a startup phase, the European option, not because the technology is bad, our clearing systems are super, our solvency system is super, but maybe in an initial period, when we don't yet have volume and scale, we will be less competitive. But if you then never choose the European option, that will become a self-fulfilling prophecy. So in that sense, at some stage, maybe you'll have to choose an option which is not so good in order to build up that scale and scope, and then we can sort of go out in the world and compete. But if you're really small and immediately compete, maybe you're dead.
If that's meant with Europe First, I'm fine.
Okay.
Okay, well, on that note, and you guys can continue this conversation in your networking break. Okay, so thank you so much to Petra, Nathan, Michael, and Tilman. Great insights from all of you. Round of applause then, please.